Today, we're diving into Bitcoin
Yeah,
and the economic forces shaping its future.
for sure.
And our guide for this deep dive is this Digital Frontier Company newsletter,
Okay.
dated February 12, 2025. They're diving into record global liquidity, the Fed's battle with inflation, and whether we're headed for a recession. So much to unpack. I'm
Okay.
excited to get into it with you.
Yeah, it's a volatile time for sure. Lots of moving parts.
Speaking of volatile,
Yeah.
the newsletter starts by mentioning Bitcoin's current price, $94,934. Ethereum is also mentioned, sitting at $2,588.63. They emphasize volatility. It's like the word of the day. Why is that so important in this context?
Well, it highlights that Bitcoin is influenced by broader economic trends. You can think of it as an early warning system. When the market gets jitter, Bitcoin's price reacts dramatically.
It's almost like a canary in the coal mine for the global financial system. That's unsettling.
It can be, but it also makes it fascinating to watch.
Yeah, I can see that for sure. Okay, so the newsletter then throws out this huge number, $174.1 trillion, the current level of global liquidity. What does that mean?
Imagine all the money circulating in the world, like in bank accounts, investments, you name it. That's global liquidity.
Okay.
And right now, it's at an all-time high. Historically, we've seen a strong correlation between high global liquidity and rising Bitcoin prices.
More money sloshing around generally means good things for Bitcoin. Is it that straightforward?
Not quite. There's usually a lag time of about 3 to 4 months.
Gotcha.
But it does suggest that the current surge in global liquidity could be a positive sign for Bitcoin.
We've got this potential tailwind from extra money flowing around, but then the newsletter brings up inflation still stubbornly high.
They're citing analysis from 42 macro. The Fed's going to have a tough time bringing it down to 2%.
I've never fully understood why that's the magic number. What's so special about 2%?
It's a balancing act, really.
Okay.
2% inflation is seen as sort of a sweet spot.
Right.
It means prices are increasing gradually, which encourages spending and economic growth.
Okay.
But if it gets too high, it can erode purchasing power and destabilize the economy.
So it's like they're trying to walk this tightrope between stimulating growth and keeping prices under control.
Exactly.
High stakes. And then there's this whole thing about the yield curve being deeply inverted.
Right.
That sounds ominous.
It is a bit of a red flag, historically speaking.
Can you walk us through that?
Sure.
What is a yield curve and why should we care if it's inverted?
Think of it this way. Normally, when you lend money, you expect to get a higher interest rate if you lock it up for a longer period.
Yeah, makes sense.
More risk, more reward.
Right.
But an inverted yield curve means that short-term interest rates are actually higher than long-term rates.
So it's like the financial world is upside down. Why does that happen?
It usually signals that investors are worried about the future. They're flocking to safer, shorter-term investments, driving up those rates, which can be a sign that a recession is on the horizon.
Okay, so we've got record global liquidity, which could be good for Bitcoin, but also stubborn inflation and this inverted yield curve pointing toward a potential recession. This is a lot to process. Where does Bitcoin fit into all of this? Is it a safe haven or is it going to get swept away in the storm?
That's the million-dollar question, right? The newsletter suggests Bitcoin could benefit from this uncertainty. When people get nervous about the traditional financial system, they turn to alternative assets like Bitcoin.
It's a flight to safety for the digital age.
Yeah.
Instead of stashing gold bars, people are buying Bitcoin.
Bitcoin has a fixed supply, so it can't be manipulated by governments or central banks.
There will only ever be 21 million Bitcoins.
Right.
That scarcity is a big part of its appeal, I guess.
Absolutely.
But the newsletter then goes on to throw out these Z-scores for Bitcoin and global liquidity. Bitcoin's at 0.54, global liquidity at 2.33. I have to admit, those numbers don't mean much to me.
Sure.
Can you decode them for us?
Think of Z-scores as a way to measure how unusual something is. A Z-score of 0 means it's on the average. A score of 2.33 for global liquidity tells us it's significantly above average right now.
Right.
Which makes sense, given all the stimulus measures we've seen in recent years.
Yeah.
Bitcoin is slightly above average at 0.54.
Tons of money is sloshing around, and Bitcoin is keeping pace.
For now.
What does that tell us about where things might be headed?
It could be a sign Bitcoin is poised for further growth. If global liquidity stays high, we could see that translate into higher Bitcoin prices. But those other factors, inflation and potential recession,
Right.
are still wild cards.
So it's not a guaranteed slam dunk. There's a lot of uncertainty out there. Speaking of uncertainty, let's shift gears and talk about what this all means for investors.
Yeah.
The newsletter lays out some specific investment strategies based on macro trends. What are the key takeaways for Bitcoin?
They recommend a diversified approach. They're bullish on Bitcoin as a long-term hedge against inflation and monetary debasement. They suggest being cautious and scaling into positions gradually.
So don't go all in on Bitcoin just yet, but it's worth keeping an eye on.
Exactly.
What about other investment options?
Yeah.
How do they see the rest of the market playing out?
They're suggesting a mix of strategies to navigate this uncertain landscape. For equities, they like large-cap stocks with strong fundamentals, but warn that rising interest rates could impact their growth.
Higher interest rates mean higher borrowing costs, which can eat into profit.
Even for big players.
They suggest hedging against this risk by diversifying into assets that tend to perform well when interest rates rise. It's about managing risk and finding balance in your portfolio.
Right.
So don't put all your eggs in one basket.
Exactly.
Even if that basket is filled with blue chip stocks. Got it. What about bonds? How do they fit?
They recommend shorter duration bonds.
Okay.
This goes back to that inverted yield curve we were talking about. When the yield curve is inverted, it signals that interest rates are headed higher.
Okay.
Short duration bonds are less sensitive because they mature more quickly.
It's a way to ride out the storm without getting too exposed to potential losses. Interesting, but I'm curious about their take on gold.
Sure.
It feels like a relic in this digital age.
Gold is definitely still in the game, especially in times of uncertainty. The newsletter highlights its role as a classic inflation hedge. When inflation is high, the purchasing power of your money decreases. But gold tends to hold its value, sometimes even increasing in price.
It's like a financial comfort blanket when things get rough. We've got equities, bonds, gold, and of course, coin. They're still bullish on Bitcoin as a hedge against monetary debasement. Can you unpack that term for us?
Sure.
What exactly does it mean, and how does Bitcoin offer protection against it? It feels like we're living in this time of just like constant money printing.
Yeah.
Governments and central banks pumping trillions into the system.
Right.
Is that what monetary debasement refers to?
Yeah, that's a big part of it. Monetary debasement means that the value of a currency is being eroded by actions taken by central banks. When they increase the money supply significantly, it can lead to inflation, which means your money buys less over time.
It's like they're diluting the value of our money by printing more of it.
Exactly.
Okay.
That's where Bitcoin comes in. Bitcoin has a fixed supply. It's not susceptible to those same inflationary pressures. Many see it as a way to preserve their purchasing power in the face of monetary debasement.
It's like a digital lifeboat in a sea of inflated currencies.
Yeah, that's a good way to put it.
But even if I buy into this whole Bitcoin as a hedge idea, the newsletter advises caution. Why is that? Shouldn't I be rushing out to buy as much Bitcoin as possible if everything's going to hell in a handbasket?
It's not quite that simple. Remember, volatility is still a major factor with Bitcoin.
Yeah.
It's a relatively young asset class, and its price can swing wildly in the short term.
So don't bet the farm just yet.
Right.
Got it. What's their recommended strategy?
Scaling into positions gradually. Instead of going all in at once, spread out your investments over time. This helps reduce exposure to sudden price swings.
It's like dollar cost averaging, right?
Exactly.
Consistently investing a set amount no matter what the market's doing.
It's a disciplined approach that can help you ride out the volatility and potentially benefit from dips in the price.
Solid advice. So to sum it all up, the newsletter's painting a pretty complex picture of the current economic landscape.
It is.
We've got record global liquidity, which could be good for Bitcoin, but also stubborn inflation, potential recession, and central banks engaging in monetary debasement.
Right.
That's eroding the value of traditional currencies. It's a lot to wrap your head around. The key takeaway is there are strategies to navigate this environment. It's about understanding risks and rewards and finding a balanced approach that suits your goals.
Couldn't have said it better myself.
Well said. And I think that's a great place to wrap up our deep dive into Bitcoin and the shifting macro landscape. We've covered a lot of ground today. I hope it's given our listeners a better understanding of how these global forces are shaping the future of Bitcoin and the financial world as a whole.
I think so. And I always like to leave people with something to think about. We've talked about Bitcoin as a hedge against instability. But what other assets might fit that description? What else might people turn to when they lose faith in traditional markets?
That's a great question. It's something to ponder. It opens up a whole new avenue for exploration. So what does this mean for you? That's something for you to decide until next time. Keep diving deeper.